Forecast on ... So what this video is about is it's a slightly weird topic, but it's one that actually comes up quite a lot, particularly when you start to get into slightly more complex builds. And it's all to do with what is my forecast actually based on. Now, this typically applies to kind of rolling historical forecast models, although there is a degree to which even with a forecast only, deal piece of kit, the concepts still apply. And it all relates to the three main ways in which you can typically create a forecast. And they are forecast on forecast, forecast on history, and forecast on closing. So in the case of forecast on forecast, what I'm talking about there is forecast performance, revenue, income, things like that are based on forecast actual activity. So the drivers of my forecast performance are actually forecast drivers themselves. Now, to put this in context, imagine something like a mortgage broker. The forecast performance of a mortgage brokerage can in one part be based on the forecast performance of their sales team, growth of the business, a number of calls, all of those activities. So the forecast activity is going to drive the forecast performance. And from a modeling perspective, this kind of mechanism it's self-evident. So don't think there's anything more complex here than there is, because it really is just the fact that you've got forecast activity that creates your forecast performance. The subtlety of this forecast on concept is when you actually start to get into things like books modeling and the use of history versus the use of closing. So to stick with the mortgage broking example, the forecast performance of a mortgage brokerage is not just based on that forecast activity. It's also based on what has taken place in terms of historical activity. So we might have spent the last year, writing mortgages, doing a whole bunch of work that has given us a trail commission. So that historical work is going to create some sort of forecast performance impact. Now, when it comes down to modeling out the forecast performance on this activity in the past, there's two main options for me. One is to do forecast performance based on my historical driver. And by that, what I mean is the profile of activity that's actually historically taken place. Alternatively, I can do forecast performance based on my closing position. Now, those two might sound like pretty comparable treatments, but they're actually quite subtle in terms of pros and cons, and particularly from a model scoping perspective, they have different impacts on things like reconciliations, data sources, and even into that forecast, there's disaggregations and nuances that one mechanism might create that another might miss, versus actually just giving you headaches around data sourcing and so on. So again, to relate this back to the mortgage broking example, I could look at my entire last 12 months of activity and forecast on my history. The benefit of that is I might have something like seasonality. I might be in a growing business. I might want the pattern of historical activity to more accurately reflect the near-term forecast of that activity from the past. Alternatively, I might just say, well, forget about the actual history. All I care about is my closing position, and I'm just going to run that off in a certain pattern. Now, from a data perspective, getting hold of a closing set of data is easier than reconstructing my history. So data-wise, it's an easier process. However, I will typically lose a lot of the disaggregation and the structural benefit of my data by using a closing data set rather than the true history. As with these other videos, again, it's just about trying to get people to think about the pros and cons of different approaches to modeling out and structuring their model. Now, in terms of this concept, there's a whole host of areas that this relates to, particularly if you're looking at things like loan books. So a lot of the banking sector, a lot of the financing sector, where you have this kind of books type mechanism where the history is slightly different as a driver to the forecast. Not only that, you also in kind of contracts world, so insurance companies, and a lot of the current SaaS modeling is all based on that kind of sticky type customer, where you want to actually understand not only where you're going, but also kind of historically where you've been to get accuracy into that kind of near-term forecast. So to relate this to the books modeling question, if I was to look at, say, a loan book, the reason why you disaggregate what people refer to as the front book versus the back book is because they have different modeling drivers. The front book is typically the book that I'm going to grow based on writing new business. Now, the forecast of that activity is what we would refer to here as forecast on forecast. And it's all related to the number of brokers, the number of sales reps, the number of loans I'm going to write. It's a growth and a business development question from a forecast perspective. By comparison, if we look at the back book, and by back book, I'm talking about all the business that's been written to date, that has, from a forecast perspective, a very different analytical piece. I'm talking about credit quality, I'm talking about runoff, I'm talking about defaults. So the reason why it's good to understand that forecast isn't just forecast on forecast. There are a few aspects to it. It will make you a better modeler to start with, but there's also a much it's a much more critical way to think about the actual analysis that you're looking to perform. So yeah, forecast on forecast, forecast on history, forecast on closing. Perfect to get your head around those. If you're modeling things like SaaS companies, you're going to really want to understand, should I be modeling based on a closing book, or is there a history profile, particularly if you're writing, 12, 24 month contracts and there is some sort of churn mechanism in there.